So describe enterprise value multiples and their use in estimating equity value. So enterprise value is what? So we have a enterprise, nothing but the company. So market value of the common and preferred stock, if we take, and then we add the market value of debt. So here I'll make a balance sheet. So they are saying you take the equity, you take the debt. OK. And so when they say market value of debt, they're saying about securities or bonds which company has issued, which company needs to pay, right? And from that, what they are doing is the total sum total of this, they are subtracting the investments, what they are doing. So the net value will be the enterprise value. So this is nothing but it measures the total company value. So how we can easily understand, right? We can we have, raised the funds or arrange the capital, and from that, whatever investments we are doing, we are removing that investment worth of amount from this total capital what we have raised. And then here the capital what we have raised, we are not taking the book values, we are taking the market values as on today. So this will have a higher value, this will have a higher value, and then we are investing that money in investments. And then the resultant value is the enterprise value. OK. So let's move forward. Now they are saying you have to calculate you need to understand, just a second. See, EBITDA is something whereby why we take EBITDA? Because there is a reason here. EBITDA is probably the most frequently used denominator for enterprise value multiples. Operating income can also be used, that is EBIT. OK, but they are taking EBITDA. Why? Because depreciation and amortization are such expenses whereby the cash has not gone out. Because the numerator represents total company value, it should be compared to earnings of both debt and equity owners. So they are saying that in numerator you are taking enterprise value, and enterprise value has nothing but debt and equity both. For equity holders, earnings is the reward. For debt holders, interest is the reward. So it is okay if you take EBIT, but sometimes why they consider EBITDA? Because an advantage of using EBITDA instead of net income is that EBITDA is usually positive even when earnings are not. Yes, because EBITDA has to undergo lot of deductions, lot of amounts will be deducted from this, and then you reach to net income, which can be negative value at times, but this can never be negative. OK, and we cannot take negative values here. So when net income is negative, value multiples based on earnings are meaningless. A disadvantage of using EBITDA is nothing but it often includes non-cash revenues and expenses. That is also a issue. Why? Because non-cash revenue and expenses, when we see practically nothing we are paying out of our pockets, but still they are concerned to find out the earnings as per the accrual concept. They're not using cash basis, right? We are using accrual concept. So a potential problem with using enterprise value is that market value of firms' debt is often not available. Yes, we know that equity trades in market, but the debt finance, what we are speaking, it should have a dedicated bond market, but it is not always the case. You won't find bond market everywhere. In this case, analysts can use the market value of similar bonds or can use their book values. So book value, however, may not be good estimate of market value of the firm, and market conditions have changed significantly since the bonds are issued. So there are a lot of advantages and disadvantages in considering the EBITDA or EV, or like market value is not easily available. But then you have to consider similar bonds similar bonds is nothing but the companies which are having the similar characteristics whose bonds are available in the market or trading in the market. Or else you have to take book value, but book value cannot be a good estimate because market values are different from book values. Okay. So after knowing all these facts, now we will do the calculation of enterprise value and upon the EBITDA multiples. So Daniel Inc. is a manufacturer of small refrigerators and other appliances. Just give me a second. Yeah. So Daniel Inc. is a manufacturer of small refrigerators and other appliances. The following figures are from Daniel's most recent financial statements, except for the market value of long-term debt, which has been estimated from the financial market data. See, there's no trading, there's no market for that. So they have to, take some similar kind of bonds or company which, has a similar kind of business, and then they have to estimate, right? Now, stock price is given, Outstanding number of shares are given. Market value of long-term debt is given. Book value of long-term debt is given. And so one stock is trading at 40. Number of shares outstanding, you multiply that, you'll get the equity value. Market value of long-term debt, book value of long-term debt, book value of total debt, cash and marketable securities, EBITD, everything is given. You have to just find out and you have to just do the calculation and find out EV by EBITD. Come on, do this. I'm giving you time. Fast. Try on your own. You know the formulas. Okay, let's do the calculation here. So we are finding out the enterprise value. You have already seen market value of equity, that is preferred equity and common equity. So common equity and preferred equity. Then you have to take market value of debt. From that you have to subtract the short-term investments. Okay. So cash and marketable securities are short-term investments. Market value of equity. Let's do the calculation here. They have already done. Market value of equity. So we are taking number of shares and it is trading at 40. This is the market value of equity. Okay. And then we have to take the debt. The debt finance here is market value of long-term debt and market value and book value. Okay. Book value of long-term debt. We have a market value and a book value. So we must first estimate the market value of short-term debt and liabilities. To do so, subtract the book value of long-term debt from the total book value of total debt. Okay. See, book value of total debt is 21 lakhs. In this, the book value of long-term debt, because total debt is long-term debt plus short-term debt. Total debt, from total debt, if I remove long-term debt, I will get short-term debt. Okay. Minus 9 lakhs. So 12 lakhs. Okay. This is the book value of the short-term debt. We can assume that market value of these short-term items is close to their book value. Yes. Add the market value of long-term debt to get the market value of total debt. So what they are saying is, we can assume in there is a fixed income which we are going to study. Okay. Market value of debt instruments approach their face values as they get close to maturity. So short-term debt here, book value of short-term debt is almost, we can consider market value as this one. Why? Because their maturity period is very, very, a shorter maturity period is seen in case of short-term debts. Henceforth, there will be less fluctuation in their values. So book value is almost equivalent to market values. Okay. So we got the market value of the short-term debt, which is 12 lakhs, and we have the market value of long-term debt. So we get the market value of debt. Which debt? Total debt. Now you have market value of total debt and you have your equity you have calculated and you have your short-term securities already given. So market value of debt plus market value of equity minus short-term investments is going to give you the enterprise value divided by EBITDA 9.6. Okay. So if the competitor or industry average is above 9.6, Daniel is relatively undervalued. If the competitor or industry average is below 9.6, Daniel is relatively overvalued. So what they are saying is this is Daniel's enterprise value upon EBITDA. They are saying if the competitor or industry, see this is Daniel's calculation. If any competitor or the industry averages more than 9.6, let's say it is 12. So Daniel will be undervalued. If it is, the industry average or the competitor's value is 7, Daniel is overvalued. Okay. So this is the calculation to understand the valuation of the firm so that we can, decide where to invest and what, kind of consideration we should have for making an investment, whether going for short selling or going for having a strategy of going long. Okay, that is holding for a certain period of time and looking forward for the values to reach to the correct value, and then we can sell. Okay, and make some good amount of profits. So this is the question which we have solved. Please have a look through this completely. We'll move forward. Okay, now we'll go to the next one. Describe asset based valuation models and their use in estimating equity value. Our third category of valuation models. See, now till now you have, first we have calculated based upon present value of future cash flows. Then we went for price multiples. Now we are going for asset based valuation. So instead of going for all this theory, let's understand with the help of a question how to go about this. So very simple. We will do a question and try to understand using an asset based model for a public firm. Williams Optical is a publicly traded firm. An analyst estimates that the market value of net fixed assets is 120% of book value. You know net fixed assets, right? You get net fixed assets by subtracting depreciation from them. And that is 120% of the book value. So if the book value is $1, the market value will be $1.2. Liability and short-term asset market values are assumed to equal their book values. So liability and short-term asset market values are assumed to equal. So they are saying if any liability you see or any asset which are, for a short span of time, okay, they will be equal to the book values. Firm has 2000 shares outstanding. That means you see market values of short term assets or securities will be almost equal to their book values, which the concept of such kind we have just discussed, right? Why? Because in a very short span of time or maturity period, we don't expect the values to fluctuate that much. Using the selected financial results in the table, calculate the value of the firm's net assets on a per share basis. So we are going to do, we are going to find out the net asset value first. Net asset value is nothing but we are going to first add all the total assets. So we're going to take cash, account receivable, inventory, and then fixed assets. We are going to change it as per today's condition. We get the total market values, value of all the assets, because short-term assets book values are almost equal to their market values. And the value of the liabilities, payable, notes payable, loans, all short-term liabilities. So need not worry, they will be equal to their market values. And adjusted equity value. So how come we can find out the equity? Total of assets minus liability is equity. So total of assets here is market value is this much and liability is this. So we get the adjusted equity value 1,44,000, right? And then we divide by number of outstanding shares, we get each share value. Okay, please find out this one and do this. This is the calculation. Now with this equity value, you multiply number of shares, you get the net asset value of the company. Net asset value is nothing but the actual assets what company own, rather than like taking some unadjusted asset values. Okay. Just have a look through this. We'll move forward. Okay, let's move forward. Now, as the entire topics, whatever we started when we started the chapter have been covered, they are kind of giving you some kind of synopsis or summary kind of thing regarding all this. They will be now discussing advantages of each and every model. So we need to focus on them. Theoretical questions would be asked to you. So explain advantages and disadvantages of each category of valuation model. So first DCF model, they are based on fundamental concept of discounted present value and are well grounded in finance theory. Yes, they are widely accepted in the analyst community. That is one of the advantages they have. Disadvantages, all estimation, your discount factor is estimation, your future cash flows are estimated. Okay, and always those are not right. What you estimate is not always subjected to be correct. Maybe your estimations may not be right. Advantages of comparable valuation using price multiples. Evidence that some multiples are useful for predicting stock returns. See, price multiples are widely used by analysts. They are readily available from the market. They are used in time series and cross-sectional comparisons. This particular one which we did, EV by EBITDA multiples are useful when comparing firm values independent of capital structure, or when earnings are negative and P ratio cannot be used. Okay, that you should be understanding when you cannot use this one, or when the earnings are negative because you are taking EBITDA, whereby the net income can be a negative figure, but EBITDA will not be. Okay, maximum in maximum cases. And comparing firm values independent of capital structures, it doesn't matter what kind of capital they have. Disadvantages of comparable valuation using price multiples. Lagging price multiples reflect the past. We have already seen. The future to, and this price multiples are the one are tools to forecast companies' future. Price multiples may not be comparable across firms if the firms have different size, products, and growth. Price multiples for cyclical firms may be greatly affected by economic conditions at a given point in time. Of course, understood fact. A stock may appear overvalued by the comparable method but undervalued by a fundamental method, or vice versa. Different accounting methods can result in price multiples that are not comparable across firms, especially internationally. See what happens in India. If you have taken a firm whose price multiple you have calculated, and if you are comparing, if you want to compare that with an international firm, and you can find out the price multiple of that international firm, but the accounting standards may not be same. A negative denominator in a price multiple results in meaningless ratios. A P ratio is especially susceptible to this problem. Advantage of price multiple valuations based on fundamentals. They are based on theoretically sound valuation methods. They correspond to widely accepted value metrics. Disadvantage based on fundamentals. See, before this also we used, but what we were discussing using price multiples. Now we are going for fundamentals, theoretical approach. And price multiples based on fundamentals will be very sensitive to inputs, especially the K minus G, the cost of capital minus growth factor. We have already seen, we took price by earning, and we took dividend by earning, and then we took K minus G, you remember, right? All estimates, growth and cost of capital. Advantages of asset Advantages of asset-based models. They can provide floor values. They are most reliable when firm has primarily tangible short-term assets. Okay, like inventory. Inventory is an example of short-term tangible assets. Okay. Now, assets with ready market values. Just a second. Yeah. So floor value, selling price minus profit. So what do you mean by floor values? Selling price minus profit. That is nothing but the cost price. That can be a floor value. Okay. Just a second. Yeah. So they are more like floor selling price minus profit. That is the floor value. They are most reliable when firm has primarily tangible short-term assets, assets with ready market values. Because see what happens, asset-based models. You took all the market values. If you remember, just see this. What we did, we wanted to find out the adjusted equity value. And how did we find out? We took all the short-term assets, which were almost the book values were equal to the market values. We took the long-term asset and we adjusted its value and found out the market value of that. And then we had all the liabilities with their market value. So you remember this, right? And see, they are most reliable when firm has primarily tangible short-term assets and assets with ready market values. If not, then how? Or when the firm is being liquidated. So you will liquidate a firm only at its market value. They are increasingly useful for valuing public firms that report fair values. Disadvantages: market values are difficult to obtain. Of course, market values are usually different than book values. They are inaccurate when a firm has high proportion of intangible assets or future cash flows not reflected in asset values. And during the assets can be difficult to value during hyperinflation. That is also a problem. When the inflation is very high, unacceptable level of inflation. To start, I'm just saying any theory topic. Yeah. See, basically, we have seen what is intrinsic or fundamental value. Present value of future cash flows can give you intrinsic value. We have seen the strategy. If at all your intrinsic value is like $100 in the market, the stock is trading is trading at 150. So your stock is undervalued. You can like do short selling and wait for the time till the stock reaches this. You have by short selling, you are borrowing the stock and selling right now and getting 150 and then buying the stock at 100. Okay, and then returning back to the person from whom you have borrowed. You made a profit of 50. Okay, and if the stock is trading at 50, then it is undervalued. Then you can buy the stock, hold it, and wait till the time it goes 100 and then sell and make profits. So this we have already discussed. Major categories of equity valuation methods we have discussed: discounted cash flow methods, multiplier models, enterprise value and asset valuation we have done. Then cash dividends are nothing but the dividends which are paid in cash when the company has good amount of cash and they want to pay that. Company can do that. Special dividends are used when favorable circumstances allow firm to make a one-time cash payment to shareholders in addition to any regular dividends the firm pays. That means apart from regular dividends, they are making a one-time cash payment to shareholders. Okay, so many will use a special dividend share profits with shareholders when times are good, but maintain the flexibility to conserve cash when the profits are poor. So they may say that when we have very good profits, we'll give you the normal dividend and also share of profits. But when the firm is not performing well, market is not good, then we will not give that. We'll conserve cash. And this special dividends also are known as extra dividends and irregular dividends. Stock dividends are nothing but paid out in new shares of stock rather than cash, and this will increase the outstanding shares. Okay, total shareholder equity remains unchanged. Stock dividends are commonly expressed as percentage. See what happens. These are the dividends paid in new shares of stock rather than cash. In this case, there will be more shares outstanding, but each one will be worthless. Okay, that is of no use. Worthless share. So total shareholders equity remain unchanged. Understood? So basically you may be knowing the concept of stock dividends, right? Yes or no?
Yes.
Yeah. So company can give stock dividends in any ways, bonus issue. Okay. So we will see for a good example to understand stock dividends. So let's say companies share, a company that is trading at $60 declares a $2 dividend. Okay. As this news becomes public, what happened? The share price may increase by $2 and hit $62. The stock might trade at 63 one business day before ex-dividend date. So this is like, stock dividend can increase the price of the shares. Okay. Just a second. This is not going to increase the shareholder wealth, although it will increase the number of shares outstanding. Okay, the price per share must decrease accordingly. Okay, because as the number of shares increase, more shares are there in the market right now. So I'll give you a small example. Just a second. See, Colin is a shareholder of ABC company, let's say, and owns 1,000 shares of ABC. Colin, I'm speaking about Colin. The board of directors of ABC company recently announced 10% stock dividend. Assuming that the current price of the stock is $10, there are see, Colin owns 1,000 shares. Okay, there are totally 1 lakh shares in ABC company. Out of 1 lakh shares, Colin owns 1,000 shares. Company announced 10% stock dividend. Okay, and the current price of the stock trading right now is $10. Okay, and what is the effect of this 10% stock dividend on Colin's 1,000 shares? 10% stock dividends effect on Colin's 1,000 shares. We will see. First, 1 lakh shares are outstanding into $10, one share value. So it will be around 10 lakhs. Okay, this is the market capitalization. Now, as 10% shares, company is giving 10% stock dividend. So what will happen? Increase in number of shares outstanding because of 10% stock dividends. So this is the number of shares are how much? 1 lakh. So 1 lakhs 10%. 10,000. The number of shares will increase by how much now? 10,000, right? So how many shares are there now? 1 lakh shares plus this extra 10,000. So there are how many shares now? 1 lakh 10,000 shares. Okay. Now we will see now how many shares Colin owns. Okay. Before the stock dividend, Colin was having 1,000 shares out of 1 lakh shares. So Colin was having 1% ownership in the company, correct? Now, therefore, Colin would own 1% of the new outstanding shares also. See, 1% he was owning previously. Now, of 1,10,000 shares also, he will be owning 1%. The shareholding is not changing, but the number of shares will increase. Okay, that will be 1,100. So the number is identical to increasing Colin's 1,000 shares by 10% stock dividend. See, the total number of shares have increased by 10,000. The number of shares what Colin had was 1,000 and it has increased by 1,100. Number of shares have increased, but the shareholding what Colin had is the same. Correct or wrong? Yes. Now we will check the price per share of ABC company. See, ABC company is 10 lakhs. Okay. With total of 1,10,000 shares. See, number of shares have increased by 10,000. Okay, but do you think this extra 10,000 shares has any value? Come on, please tell me yes or no. Did I mention any value for this? Did I tell you that the company which is giving 10% stock dividend is giving some value for its stock, extra stock what it is issuing? Did I say that? See, 10% was the stock dividend. That 10% of 1 lakh was how much? 10,000. But this 10 extra shares are trading at what value? Did I say you any value for this? Please tell. 1 lakh shares are trading at the rate of $10. That is what I explained, correct? But 10% is the stock dividend, right? So now the number of extra shares are 10,000. Did I say any price for this? Come on. I'm asking a question. I'm not getting any answers from any. I did not give any value for this. Okay. So now the total number of shares outstanding is 1,10,000. Okay. And now we are seeing that price per share of ABC company, correct? So market capitalization of ABC company was 10 lakh with 1,10,000 total number of shares outstanding. So this 10 lakh is dollars and 1,10,000 are number of shares now after stock dividend. We will divide this. Now tell me what's the value 9.09. Okay. Okay. Now see the magic. I'll put everything on the table. See, first, again, we will see this. You know, Colin had how many shares? 1,000 shares. Okay. How many shares are there in the company? 1 lakh totally. Colin owns how much of this? 1% because he has 10,000. He has 1,000 shares. Okay. Company has declared 10% stock dividend. 10% of 1 lakh is 10,000. Number of shares now in company is how much? 1,10,000. Okay. Fine. Company shares are how many? 1 lakh. Each share is trading at how much? $10. What is the value of this total? 10 lakhs. Okay. Now we will see the per share value after stock dividend is done. So 10 lakhs divided by 1,10,000. How much? 9.09. The number of the value of a share has decreased because of number of shares increasing in denominator. 10,000 shares I told you are stock dividends, but I did not tell you anything about its market value. Okay. And the Collins shareholding is 1%. Okay, if it was given. So out of 1 lakh he had 10,000 shares, and I told you, okay, like Colin is owning how much? Just a second. Colin owns 1,000 shares. Out of how many shares? 1 lakh. So Colin's shareholding is 1% that we discussed. Okay. Now number of shares are now 1,10,000. Now Collins holding in this also will be 1%. That won't change. That is 1,100 shares. Okay. So the share value is this. You see the market capitalization is not getting affected because of bonus shares. How? I'll show you with the help of a table. See, shares outstanding, no dividend, previous case, 10% stock dividend. Okay. So shares outstanding are 1 lakh. Now here 1,10,000 after stock dividend. Price per share $10. Here it is 9.09. That was the catch. So market cap has not changed. The market cap is the same. It is 10 lakhs dollars. Here also it is 10 lakhs dollars. Okay. So that is the thing. This has not changed. Okay. Only price per share has changed. And number of shares outstanding has changed. Okay. So we will move forward now. Stock split is nothing but splitting one stock of $100 into 10 shares to make the shares more marketable. Reverse stock split is 10 shares are already trading in the market. They club all of them and make one stock of $100. That is the reverse stock split. Share repurchase, nothing but company wants to buy back its own stock from the market so that they can privatize themselves and can have more shares, more number of like can have bigger stake in the company. Okay, the founders can do that. The company itself can do that. Now, dividend payment chronology. See, first the dividends are declared. Then once the dividends are declared, it's called ex dividend. Okay, and then like there are many shareholders, right? Like whichever shareholder's name is recorded like to be given as dividend, so holder of record date. Okay, and after that the payment is done. So first the dividends are declared, then once the dividends are declared, dividend has to be paid, so that is called ex dividend. Now the dividends, now the shares are called ex dividend shares because now the dividends have to be paid on them, right? So ex dividend date, and then we can see here that first day on which a share purchaser will not receive the next dividend. Okay, once the dividend has been declared, the shareholder will get that dividend only. So the first day on which a share purchaser, now a new guy who wants to purchase the share will not get the next dividend. The ones who have already been the shareholders of the company, see, it is very important to understand. Declaration date, the date the board of directors approves payment of a dividend, specifying per share dividend amount, how much per share they are going to pay. The date the shareholders must own the stock to receive the dividend. See, now the existing shareholders will only get the dividends. Okay, and the date the dividend payment will be made is the payment date. So all these are very clearly mentioned. Declaration date, the dividend will be declared, and then the date the shareholders must own the stock to receive the dividend is record date. You should have the stock on that date to get the dividend, otherwise the dividend will not be made. Dividend will not be paid, and the payment date is when the payment is made. Ex dividend date, the first date on which a share purchaser will not receive the next dividend. That means the ones who are already the owners of the existing stocks will get the dividend, but the new purchaser will not get the next dividend. Okay, the ex dividend date is 1 or 2 business days after the holder of, before the holder of record, before, and the holder of record date, they should have the stocks actually to get the dividends, and the payment date is nothing but the date on which the payment is made. Okay, see, on the ex dividend date, what happens? The share price will decrease. Why? See, if you see the accounting wise, equity, let's say we have 1 lakh equity. Okay, retained earnings of 50,000. Now the equity is 1 lakh 50. Let's say number of shares outstanding is 10,000. $15 is each share value. Let's say the equity is 1 lakh. Retained earnings is 50,000. Dividends are paid as 20,000. Dividends are subtracted from retained earnings. So this makes it 1 lakh 30. Outstanding shares are 10,000. Now you tell me what is the share value? $13. Okay. So share price will decrease. Okay. This is the end of equity. We have finished the equity valuation topic. Now the next class, what we are going to do is long-term liabilities and equity. Okay, this and income taxes, if we do this, total FSA will be done. So let's start that topic tomorrow, all of you. Thank you so much.
Bye.
Bye bye, all of you. Bye.